here on this call, we talk a lot about interest rates. Would we love lower interest rates? Absolutely. But for a macroeconomic standpoint, I actually think they're doing pretty well so far.
Yeah, I mean, if we're already seeing negative GDP, I think, we'll officially be in a recession.
And so when we see 5.4 months of supply in attached housing, that is a concern, because now we're getting sort of outside of the neutral market and into the buyer's market.
We were in negotiations.
Investing in real estate, they're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I am your host, Kevin Amolsch. With me today, super special co-host guest, Mr. Justin Cooper. If you're new to the podcast, this is a podcast helping real estate investors and real estate educators. So if you're out there buying properties to flip, or you're building a rental portfolio, or if you're providing content to real estate investors, this is the podcast for you. If you like what you hear, which I know you're going to, especially on our Market Pulse update, please 5-star review. So with that, Mr. Cooper, why don't you tell the listener who you are in case they don't know, which would be really surprising, but tell them who you are, and then let's introduce our guest.
Yeah, Kevin, thank you so much for having me, as always, as a co-host on the podcast. I hope there's folks that don't know who I am. I hope there's folks who don't know who you are, because that means they're new listeners. And I think this is the perfect episode for new folks to be joining us, because we're going to cover such great information, very relevant, very timely information. So I am Justin Cooper. I am Senior Loan Officer here at Pine Financial Group. We are hard money lenders. So all day, every day, we talk to investors about buying investment properties, fix and flips, rentals. We help them run their numbers. We supply the financing for them. I've been with Pine since 2011, and my investing career goes back even further. I bought my first property back in 2007. So, all day, every day, talking to real estate investors and helping them make money in real estate.
Well, thank you for co-hosting this with me.
It was my pleasure. Thank you so much.
Mr. the infamous Joseph Massey. So we're doing the Denver Pulse update today. So welcome back, Joe.
Dude, I'm so excited to see you guys. I look forward to this every quarter. I'm always excited for the conversation, and just really grateful that you guys keep bringing me back on the show. For everybody that has not met me or does not know me, my name is Joe Massey with Castle & Cook Mortgage. I've been in the mortgage business 23 years. I've been with Castle & Cook since 2009 and have been a partner with Kevin and Justin, since I think 2011, 2012. We've been working together more than a decade now. And really enjoy the partnership with you guys, enjoy working with you on transactions, enjoy your happy hours that you guys put together. The education that you guys give out is second to none in the Denver area, as well as in the Minnesota area and the other markets you're in. So just really grateful for you guys, including me every now and then. So thanks for having me.
Yeah, no, I really love this as well. And I think we're lucky to have you join us. I mean, you just have a new book that came out. I don't want to just get into a pitch here, but you just had a book, and I downloaded. I mean, I didn't download it. I bought it from Amazon. I'm super stoked to read it. You want to quickly tell us what that is?
Yeah. So the first book that we just published about a month ago, and I think we're recording some of this on video, it is AI for real estate agents. So how real estate agents can succeed with AI. So my friend and business partner, Mr. Lon Welsh, we wrote this book. And it is all about artificial intelligence and how you can use it in your business. So whether you're a real estate agent, whether you're working with buyers, sellers, or you're a real estate investor, I think there's a lot of things that AI can do to help your business. So go to Amazon, check that out. Again, how real estate agents can succeed using AI. You can get it on Amazon. I think it's $6.97 in paperback or 99 cents on Kindle. And I have another book that I wrote recently, but we can talk about that later. So let's keep going.
Cool. Did you read his book yet, Coop?
It's sitting on my shelf. It has been opened, but it has not been read cover to cover yet. But it's such a great topic. I'm actually really excited to dive into it, because I've been hearing a lot about AI. I've been working with folks about AI. We're using more AI in Pine Financial's business. So I'm really interested to see what Joe and Lon wrote about, specific to real estate investing and how agents are using it, see how we can benefit from it. And I think a lot of the stuff just crosses the board, right? So really grateful for Joe having written the book, so I don't have to do all that research myself.
Oh, I could go down the AI rabbit hole for like hours. So we're not going to talk about that today. Maybe we should do another whole nother podcast on it, but I have learned a ton, and you would be amazed at some of the stuff it can do.
All right. That sounds like we need to schedule that.
Yeah, we should.
All right, dude, you're up. We're gonna get you scheduled. All right,
Great.
but that's
I
not
love
what
it.
we're talking about today. We're talking about what's going on in Denver real estate trends, what we're seeing out there. How can we help the listener? Obviously, the macro side of things, Joe, is going a little berserk. It all comes down to the tariffs, of course. We're recording this on 5/8, so this is Thursday, May 8th. I think it releases maybe Monday. I should know that. So by then, the news is going to be stale already, right? Because it's happening,
Yeah.
it's changing so fast. But we did just get some jobs numbers out, looking really
Mhm.
strong. Unemployment is not moving, over expectation of job creation. We have inflation that's sticky, but it's not really going up.
Mhm.
So the Fed, it's kind of stuck here. They're getting tons of pressure from Trump, lower, lower, lower. They're seeing good job numbers, good inflation. It seems like everything's going okay. So they're in a kind of stuck, aren't they?
They really are, and if you take out commentary for a moment, if you look just at the data, things are going pretty well from the Federal Reserve's point of view, right? You're looking at inflation. It's not going down. It's not going up. It's staying sticky at, 2.5%. And their goal is to get it to 2%. But they're getting pretty close to that. And their second mandate and their second goal is to stay at full employment, which we're really darn close. I think we're 4.1, 4.2% unemployment, which is not the lowest it's ever been, but historically in the bottom 10% of unemployment. So love them or hate them, the Federal Reserve, they're doing a pretty good job with their dual mandate. Now, here on this call, we talk a lot about interest rates. Would we love lower interest rates? Absolutely. But for a macroeconomic standpoint, I actually think they're doing pretty well so far.
What do you think, Coop?
I mean, of course, everybody wants lower rates. I think people have finally realized that the interest rates are here to stay, right? That we're going to be
Yes.
holding steady. And this is what we've talked about the past couple of times. It's hard to say though, because the market is just every aspect of every market is so crazy right now. But I think people have finally gotten used to those high interest rates. But of course, we want lower interest rates. So I think the conversation is now interesting. I'm really interested to hear what you guys think. Is the only people, or when people are saying they hope for lower interest rates, what almost they're hoping for is the bottom to fall out of the market, right? Of a lot of markets. And I think people are realizing that that's a scary thought, but they're also realizing that there's a chance of that. And so I think people are almost hoping that rates do stay steady, because if rates are going down, then there's other things going on that have caused them to go down.
Mm-hmm.
What an interesting way to look at that. And very sophisticated. I agree 100%.
Me? Thank you.
Yeah, you're not used to hearing that, are you, Coop? Yeah, so the Fed did just meet, and the minutes came out, and the presser came out, and they did not move rates, right, which the market expected. They're not expected to move rates at the next meeting either. So this has Trump very upset, right? And now, just this morning, they're saying that they're making progress with these trade negotiations, and now UK and supposedly UK and the US have a deal, yeah. And now they're like the stance on China's lessened, so we're seeing a rally in the market. This is all happening right now. Again, by the time you listen to this, listener, it's probably totally different. But I guess other than the tariff stuff and the fear and the interest rates sticking in the mid sixes, is there anything else on the macro level we should be talking about, fellas?
Yeah, I think
I'd
Joe
like
was
to talk.
mentioning.
Oh, go ahead.
Well, I think before we hit record, Joe was mentioning an article about the home selling season ending early, and so I'm really interested to hear more about that.
Yeah. So that's more of a local topic. So I definitely want to talk about that because that was an article in the Denver Post. But can I talk about the 10-year Treasury and how it is not reacting as we may normally expect it to when we see changes in the stock market? You guys
I'm
may
dying
mind
to
if we
hear.
go
I'm
to-
dying to have this conversation, Joe, because I'm with all these tariff talks and what China specifically, but others, what their stance against the U.S., the stance that they're taking. I'm wondering how that's impacting treasuries, because I think that's kind of why the rates are being held up. Because if foreign investors are not coming and buying, that's not going to drive rates down.
That's
So I
right.
think it's being held up by, I mean, the tariff stuff is so much broader than I think people even realize. So I'm not trying to prime the pump here necessarily, but I am excited to hear what your thoughts are on this.
Yeah. So let's take out tariffs for a minute. Let's just say what kind of generally happens. If you see a big decline in the stock market, that means people are taking money out of stocks. And where do they normally put that money is into bonds, which drives up bonds prices, drives down yields. Interest rates are tied to yields, and you see interest rates go down. Now, what happened over the course of the past 30 days? A lot of money came out of the stock market, just like we explained. You traditionally would expect it to go into the bond market. Prices go up, yields go down, rates go down. What actually happened? That didn't happen. Money came out of the stock market. It did not go into the bond market. And so what happened is you saw bond prices went down, yields went up, rates went up or stayed the same, depending on what day you looked at it. And everybody was trying to figure it out. It took about 2 weeks. I'd like to point out that I figured it out after about 24 hours. Who's the largest buyer of mortgage-backed securities and the largest buyer of 10-year treasury? Foreign countries, right? Japan, China, France, Germany, etc.
You mean outside
so
of the United States buying their own stuff?
Well, that's true, United States. But what happened with the foreign buyers of treasuries, they said, we're going to take our money out of the stock market and we're not going to put that money into bonds. We're not going to buy treasuries because we're upset over what's going on. We're just going to take that money back to our shores, or we're just going to leave it in cash. And so once that was not working the way it normally does, I kind of put 2 and 2 together and said, the foreign investors are not putting their money into bonds because they're upset. And about 2 weeks later, we saw an article come out from Newsweek and CNN and Fox Business that said, oh, a lot of money flowed out of the stock market, went back to offshore accounts, foreign accounts, and did not come back to the bond market. That's why things didn't react as we expected. And I was sitting there saying, wow, dumb old Joe Massey figured that out in like 24 hours. And it took 2 weeks for a lot of folks to put 2 and 2 together. So that was a unique situation that we've seen. And I think it is exacerbated by ongoing trade talks that, hey, we may have really big tariffs, we may have no tariffs, who knows? But those foreign buyers of 10-year treasuries are not coming back in and buying those. They're saying, hey, we're going to wait and see what happens. And that's what's leading rates to remain elevated, although we've seen a little bit of improvement in the last 2 weeks, about 20 basis points, but that's a very marginal improvement, which is just a function of natural fluctuations. We've not seen a lot of that money come back from offshore to buy 10-year treasuries and mortgage-backed securities.
So let me ask you this. The president came out today and announced the deal with the UK.
Mm-hmm.
He also was questioned about China. Now we can't shy away from this, gentlemen, because this is happening. So China is carved out, right, from everything else. They're specifically being targeted by the United States. Currently, 145% pretty much across the board tariff on China. Now, when asked about that, is there a chance, is there room to come off of that? He said, well, of course, this is basically, I'm paraphrasing, of course, because we can't go any higher. It's 145%. So that the deal with the UK won, but also the loosening stance on China is what shot the stock market up this morning. But I'm getting to my question here. Trust me. If we do loosen the stance on China and China has more confidence in the relationship with the United States, does that foreign investment come back into the United States in the form of bonds and treasuries? And if so, will that impact rates?
My answer is going to be nuanced. I will say yes, I do think that money comes back in, but I don't think it happens overnight. I think it will take 3, 6, 12 months for you to see that. I think it'll be a trailing impact. The reason there is because some of the rhetoric is very volatile, that one day it's this, the next day it's 180 degrees. I think if I had $1 billion of money sitting in my account in China, I would not put that into bonds overnight. I would wait and see, are things going to settle down? And I think we're seeing a lot of people do that, not only huge foreign investors, but here on the streets. I think we're seeing a lot of people say, you know what, I'm going to wait. There's a lot of volatile swings in both directions. I want to just wait and see what happens. What I'm doing right now is mostly comfortable. I'm not uncomfortable enough to invest $1 billion in treasuries. I'm not uncomfortable enough to buy a house. And those are two completely different people, but I think they have the same message of let's wait and see. So do I think that money will come back after trade deals? Yes, but I think it will take time and perhaps a long time.
I think
And it all
that
goes to consumer confidence, right? Like the consumer of buying houses and the consumers of our bonds.
That's right.
Yeah, and that's a good point, Justin. I think we were talking about right before you jumped on, but I want to get this in, and then I want you to ask the question. But the experts are telling us, the economists, I'm talking about Fannie Mae, the Mortgage Bankers Association, the big guys, right? They're telling us that we should expect the interest rates to stay in the mid sixes throughout 25 and maybe even all the way through 26. So that, I guess, kind of goes to what you're saying with the slow process with foreign investment coming back in.
Yeah, I think it's going to be a long time. Now, a long time next month? No. 3, 6, 12 months? Yeah, I think it's going to be pretty far down the road before we see any big relief on interest rates. And so if you're an investor, figure out how to invest with rates at 6.5% or 7 or 7.5%. If you're a home buyer, really look at your budget. Maybe you wanted to buy a $700,000 home. Now maybe your budget is $500,000. I still think it's a good time to buy real estate, and we're going to touch on that more when we talk about some local stats. I think it's a good time to buy real estate right now, and I think it could, in the coming months, become a better time to buy real estate.
I feel like I cut you off there, Coop.
No. I was just kind of making more of a statement than a question, but I do have a thought here. Love to get your feedback, guys, on consumer borrowing. I heard borrowing has been up, especially in March. So what do you think? I mean, obviously, what I was reading was saying, people preparing for the tariffs, so they're borrowing more money, or at least they're paying off their debt more slowly, making minimum payments. Joe, what kind of impact do you think that's having?
Yeah, so you're exactly right. There's a lot of people that are still spending. So if you look at consumer spending over the last 60 days, it's actually been up. And the theory, there's a lot of people that say consumer spending is taken off. That's great for the economy. Well, I don't think that's correct. I think we are fast forwarding consumer spending because people want to be ahead of the tariffs. So they're looking at things. Maybe I was going to buy a washing machine, a dryer, and a car, and I was planning to do that in third or fourth quarter. Maybe now I need to do that now, so I'm not subject to the prices going up as much as 145% when I want to buy that in September. So I think we're taking a paycheck advance on consumer spending. We are fast forwarding it into first quarter and now into second quarter. And I think we're going to see a big slowdown if all these tariffs come to fruition. We're going to see a big slowdown in third and fourth quarter, which is why a lot of folks are talking about potential for a recession.
Yeah, I didn't read what you read, Coop, but I do know that GDP is this Q1 is negative, and so that has people nervous. But the reason for that is what we're talking about here. They front loaded a bunch of purchases. They imported a whole bunch. Apple is probably the biggest one, just bringing in a ton of iPhones because they're trying to get ahead of the tariffs. And then of course the reciprocal tariff got extended until July, so we might have a Q2 problem also.
Right.
But the way the GDP is calculated shouldn't include imports at all. It's all what we're producing and we're pushing out. But the problem is if someone buys an iPhone and that iPhone was manufactured overseas, you're supposed to subtract out what was imported to get the actual net amount of that consumption, or the consumption is the number you're trying to get to, right? So you do have to subtract out the imports in the GDP. So when you front load it, then that's why you're seeing a negative GDP.
That's right.
But you have 2 quarters of negative GDP, and then what does that mean?
That's a recession.
Well,
That's
we're
the
told.
textbook definition of a recession.
And with this reciprocal taxes getting pushed out till July, be very interesting, yeah?
Yeah. I mean, I'll tell you, anecdotally, I've been looking, I need to get a new laptop. My laptop is like 4.5 years old. The warranty expires in 6 months. And I was browsing at Best Buy the other day, and I was looking at like a top end laptop, and it occurred to me, I was like, you know what? I might need to buy this now, because in 6 months, when my laptop is at 5 years, and for me, that's kind of what I'm like, all right, this thing is on its last legs, time to buy a new one. I might fast forward that by 6 months. And as I was looking at that, a little light bulb went off, and I was like, I'll bet this is what a lot of people are thinking if they need a washing machine, they need a car, they need a whatever, an iPhone, maybe I'm going to fast forward that purchase. So it happened to me just in my day-to-day browsing.
Yep. I don't know. I mean, it is interesting, the negative GDP quarter. And I know people freaked out about that, but I don't think it really impacts us or our listeners at all. Do you see any impact there?
Negative GDP, no. I don't think that impacts us. What I will tell you that I think impacts us is consumer confidence. And this is kind of the next topic on a macro level that I wanted to touch on. Consumer confidence, as of the April survey, was at 50.8. That is the lowest it's been since they started keeping records back in 1954. And consumer confidence is where you ask the consumer, how do you feel about the upcoming 12 months? And that is the lowest rating in the last 60, what is that, 60, almost 70 years. People don't feel confident about where things are going. And it's not how confident are you about the economy? How confident are you about your job or this, that? It's just very simple. What's your confidence about how things are going to look in 12 months? It's the lowest it's been in 70 years. Now, let's take me and you guys out of this for a moment. If I'm a buyer, first-time buyer, or maybe a trade-up buyer, and I'm saying, I don't feel great about the next 12 months, am I going to buy a house? No, I might just sit and wait. So back to what Cooper said earlier, you've got these bond buyers that have $1 billion that they may buy treasuries. They're uncertain, so they have a confidence problem. Now we've got the individual on the street who's thinking, maybe I want to buy a house. They're uncertain. They've got a confidence problem. What does that lead to? Everybody's just kind of sitting on their hands. Now, what we're going to talk about in a few minutes, I think that leads for opportunities, particularly the people on this phone call or that are listening to this podcast. I think there's going to be some coming opportunities, particularly here in the Denver market, which I know we're going to talk about.
Yeah, and a lot of what we're going to talk about probably is trailing indicators, because that's how real estate goes. It's a sold comp is in the past, right?
That's
so
right.
It's already
That's
happened.
right.
The confidence that you're talking about now is a leading indicator. So that doesn't necessarily mean something is going to happen, but it is an indicator of some future potential, right?
That's right.
What do you think about all this, Coop, before Joe starts sharing his slides and walking us through the Denver stats?
Yeah, I mean, if we're already seeing negative GDP, I think, we'll officially be in a recession, by the summer, because, like we were just saying, everybody's front loading their purchases, buying everything now, right? Or they have been, once they started hearing about all these tariffs and everything, that I think everybody is going to continue to take a wait and see. How is this all going to shake out? How will it play out? How will things continue to change? Even though we made an agreement, how does that change? And so I see a lot less spending coming. And so I think, as we always say, right, on these podcasts, like, check back in a year and rewatch these and see if we're all true or not. But yeah, I definitely see the recession coming. I don't see all this a huge bump up in GDP and spending and everything.
Maybe we should do like predictions. Like we should do December episode predictions and then go back and listen to it and see how
that's a good idea.
We were.
I like that. I like that a lot.
That's a good idea. And we could like gamble on it, be like, so who was right? You got to buy me a cup of coffee. Oh, Cooper was wrong 4 times. He's got to buy me 4 cups of coffee.
That's $38 now.
Exactly. Yeah.
There's a tariff on coffee beans.
That's right.
This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com. All right, Massey, what you got for us?
Yeah, so I only have one slide that I want to share. The first thing I want to talk about for local stats, and this article was in the Denver Post yesterday. And the headline is, "The Bloom Falls Off of the Prime Home Selling Season Early." And the basis of the article is on April 30th, there were 12,000 unsold listings in the Denver metro area. That's the highest inventory level that we've had in 14 years. So the highest inventory level, well, let me rephrase, the highest inventory level at the end of April in the last 14 years, all right? And that is an increase of 22% from the end of March. So we've had a 22% increase in listings month over month, and we have just under, it's 11,964, so just under 12,000 listings on the market. Now, what does that mean for folks on the phone call? If you're a seller, you have a lot of competition. There's a lot of other properties listed, whether you're listing at 500,000, 800,000, a million, you need to look at your competition and you need to have your home parade ready. What do I mean by that? Great photos, great price, clean, staged. Every single showing is going to be really important. And that's the slide I cannot get to stay up, shows the average number of showings last month per listing, 5.5. 5.5 showings per listing per month. So if you have a property that's listed and you're only getting 1 or 2 showings per month, you're probably overpriced. If you're getting 6, 7 showings per month, you're probably just right about right. If you're getting 12 to 15 showings, you're probably going to have an offer really, really soon, or maybe even a couple of competitive offers. But that showings per active listing, that's a metric that I track really closely because I like to know how many people are going through each listing. And the more people that are going through the listings, the more activity and the more offers you're going to receive. So if you're selling a property, look at how many showings you've had in the last 30 days. If it's below 5, you're overpriced. If it's above 5, you're maybe about right. If it's really greater than 5, you should have multiple offers by now. So that's the important information for sellers. Buyers. I think buyers are coming into not exactly a buyer's market, but a much more balanced market. I'm seeing seller concessions. 70% of my transactions in the last 60 days have had seller concessions, ranging anywhere from 2 to 3% of the contract price. I personally think that seller concessions are better for the buyer than a price reduction because that allows you to buy down your interest rate, allows you to minimize your cash into the deal up front. You can potentially do a 2-1 buy down, which saves you a ton of money in the first couple years of the loan. So seller concessions are something that buyers can really negotiate on right now. The other important thing that buyers can negotiate on, inspection items. I have seen sellers cave on inspection resolutions with 10, 12, even 15 repairs needed on the property. There was a period of time that you couldn't even put an inspection resolution into your contract because the seller would say, no way, I'm not taking that. And now you can absolutely ask for all of the appropriate repairs on the property, and the seller will do it because they know you may be their only offer. So buyers are regaining some negotiation power, and I think that's going to continue. I do think we're going to see an increase in listings through May, June, and July. Why do I think that? Because we always see that. There's a little bit of a mismatch between when buyers enter the market and when listings enter the market. And we always see listing activity or inventory go up through the summer months, May, June, July. I think we're going to see that. And I think it's going to be a lot of opportunities for buyers to, again, get concessions, get inspections, and potentially get reduced prices on properties.
That's amazing information. I was taking notes because a lot of this will relate back to my clients, great talking points, when we're talking to our borrowers. But I'm interested, this is like the entire market. Is there any kind of breakdown between different price points and what price points are moving faster or slower? Or do you have any info like that?
Yeah, luxury greater than $1 million is actually right around 4.5 months of inventory, which is truly considered a balanced market. Below luxury, so $999 down to starter homes, we're seeing right around 3 to 3.5 months of inventory. So still a seller's market, but not a insane seller's market like we had a few years ago. Sellers still have more power, but not all of the power. And so if you've got a $400,000 home and you've listed it and you've only got 3 showings and somebody shows up and offers you $395 and 3% seller concessions, I would think really, really long and hard about taking that offer because that may be the best offer you're going to get. And something I learned back in 2009 and 10 when there was 30,000 homes on the market, your first offer is generally your best offer. So if you're a flipper or you're trying to sell one of your properties or you're a developer, when that first offer comes in, you might think long and hard about taking it or at least negotiating on it because it may be your only offer for a long time.
Yeah. I love the fact that you said that 70% of the loans that you've been closing have concessions, and that that it's between 2 and 3%. Because when I'm running numbers with clients, right, it's not just how does the financing and how much money down do we have, right? Because Pine Financial, as our hard money loan is, hopefully it's no money down, right?
Right.
Which is fantastic. But I also analyze the deal all the way through and say how much profitability will there be. And so many times, right, HGTV never calculates this. They don't talk about the closing costs when you're buying or selling. And so when we're talking about that and running the profitability, potentially it's somewhere around 10%, 6% for agents, up to 3% in concessions, and then 1% for miscellaneous title fees and such. And for a long time, I would have that and then say, we can assume 0%, maybe 1% in concessions. And now, like there's the data saying we need to be calculating at least 2 to 3%, right? To be safe, to be accurate, not even safe, to be accurate. And I think that's such an important stat right there.
Now, one thing I want to add to that, the MLS does track this, the stats from DMAR, and their stats show that 45% of transactions in the last 30 days had seller concessions. So if you're listening to this, my transactions, 70% of them have had seller concessions. The market as a whole has only been 45% of transactions have had seller concessions. So I chalk that up to all the folks that I work with are just better negotiators. But right to your point, Justin, absolutely, you need to assume roughly 50% of the time you're going to have to pay a pretty sizable amount of seller concessions in the current market.
Yeah,
exactly.
Except for it's more than 50% because we're dealing in the starter home type.
That's
fix
true.
and flip.
That's a good point. So you guys are probably more to the 70%, just like my clients.
Yeah, because your clients are investors, so they're not buying the $1 million home to rent out, right? They're buying
correct
a little cheaper. And when you're getting a loan, you usually get a concession. If you're out there buying $1 million plus, you're oftentimes paying cash.
That's right. That's exactly right.
So I'm looking at some statistics here, Joe, and this is just the city and county of Denver, and months of supply for detached is 2.5. Months of supply for attached, 5.4. So I guess you blend those together and we're coming up with what you were sharing with us. But it's what I'm finding interesting about that is the distinct difference between attached and detached. I'm assuming this is insurance related, something to do with the HOA fees going through the roof or special assessments, or what are you seeing? Because I know you do a lot of condos. So what are you seeing in the attached housing market?
Two things that are causing that. Number one, insurance, and number two, HOA dues. And they're actually linked together. So insurance, we all know, has gone up over the last 3 years, more than 70% in the state of Colorado. And that's regardless of what type of property you own. But condos and attached homes have experienced an even higher increase. And so what happens with a lot of homeowners associations? Well, we've got to increase, our insurance premium is going up, so we've got to increase HOA dues. Well, then the next year, we got to increase HOA dues again. Well, then the next year, who's running the HOA? Like Bob in Unit 3C, right? He's a regular guy, normal dude, just trying to do the best he can. He's tired of telling all of his neighbors, yeah, we got to increase your HOA dues again. We got to increase your HOA dues again. So what do? They find cheaper insurance. And what's the easiest way to reduce your insurance cost is increase the deductible. So I've actually seen a lot of homeowners associations go from a 5% wind and hail deductible to an 8 or 10% wind and hail deductible. When you do that, Fannie Mae and Freddie Mac, which as we all know in this call, back roughly 85 to 90% of the mortgages in the United States, Fannie Mae, Freddie Mac, FHA, and VA, so now we're getting close to 100% of mortgages in the United States, they all have a requirement for HOA master insurance that the wind and hail deductible is 5% or less. If that wind and hail deductible is greater than 5%, that property and that project is no longer eligible for any type of conventional FHA or VA financing. Now remember, we've got Bob in 3C who's not a mortgage lender. He's not, on our podcast. He doesn't know this. He's just trying to do the best he can to not increase HOA dues on his neighbors. And he says, we feel really good. Let's go to an 8% wind and hail deductible. All of a sudden, nobody in that complex can sell their property and get a new loan for that new buyer. What does that do to your marketing time frame? Extends it significantly, because now fewer people can qualify for a portfolio loan. It also drives down your prices, because people that can qualify for a portfolio loan or pay cash are generally what? Investors. And what do investors want? A discount. So people don't realize insurance and fiddling with the deductible will actually lead to longer times, depressed prices, and a difficulty in people buying those properties. Here's where the opportunity lies. People that are on this podcast, there's opportunities in condos because there's 5.5 months of inventory. You can buy it. You can probably get a reduction in price. You can probably get some seller concessions. Know that you're going to have a tough time selling it until the HOA resolves the insurance issue. But guess who doesn't care about insurance? Tenants and Section 8. They're just excited to have a place to live and a place that they can afford. So there's going to be some opportunities that I think are presenting themselves right now and will go through at least the remainder of the year, that you may be able to get some reduced prices on condos and attached townhomes. So that's a really long answer. What do you guys think?
Well, you just mentioned that this will probably continue through the end of 2025, but is there any indication that it will change, or do we see these issues continuing?
So my opinion on that is Bob in 3C is getting a lot of hate from all of his neighbors. Hey man, why did you get this cheaper insurance deductible? Because now I can't sell my home. And so Bob in 3C and the rest of the folks on the HOA board next year are going to have to say, all right, we've messed up. Now we've got to get insurance with a 5% deductible so that we can have financing in our project again. That's going to be a higher cost. We're going to have to increase the HOA dues, but at least there will be financing available again. So there's a mixed bag, right? You want to save money. You don't want to pay for higher insurance, but when you do, you don't realize you're shooting yourself in the foot. And so we've seen a lot of that. And I have not personally had any conversations with HOA managers, but I know that some of them are getting a lot of hate and a lot of hate mail from the people that live in HOAs that they didn't realize, oh, changing our insurance deductible is going to foul this up. You got about a year for all of the insurance to come through and renew, right? And it's on a rotating basis every single month. But this is something that we saw happen to a lot of homeowners associations. And I do think they're going to come to grips that, we just have to pay more for insurance. When you do that, yeah, your HOA dues are going to go back up. But guess what? If I buy the property today at a depressed price, and I know that somewhere in the future, financing is going to become available again, what's that going to do to prices? They're going to go back up. I'm going to make that spread. So buying non-warrantable condos, again, kind of like AI, I could go down a 2-hour rabbit hole on non-warrantable condos, especially for minor items like insurance. Great investment strategy. It's one of my favorites that I've done personally a number of times.
I want to get into your DSCR loan because it sounds like that might be a good product here. And so how our listener can really take advantage of what you're saying. But when I'm looking at numbers, Joe, like you, I like to dissect them a little bit and try to really understand what's creating that, to see if there's opportunity or if there's a threat to my business, right? And so when we see 5.4 months of supply in attached housing, that is a concern, because now we're getting sort of outside of the neutral market and into the buyer's market, right?
Correct.
So what we're typically going to see when you have that many months of supply is a decrease in value. So I'm looking at it right now, median sales price on attached product down 8% year over year. So here's where I want to dissect it a little bit. When we say attached housing, not all attached housing has HOAs. Some of them are party walls. So let's say it's a duplex and there's a party wall agreement between the two owners. What happens if something happens, but there's no manager, there's no HOA, there's no fees, there's none of that. So really what you're talking about here is even a larger problem. It can be magnified here because you have to take out all of those non-HOA attached housings out of this number. I don't know if you can do that or not, but if you take all the non-HOA out, that negative 8% might be significantly higher on condos with HOAs. Are we in a free fall?
My answer to that is no. I don't think we're in a free fall. I think we're in a natural correction due to financing issues. Again, Bob in 3C, good guy. Multiply Bob in 3C times 1,000 different homeowners complexes. They just didn't know, right? Nobody's intentionally trying to sabotage values. They just didn't know.
So is now the time to buy, I guess is what I'm getting at, or is this something like, should we just wait just a little bit and see what's, I'm asking honestly, I'm just curious what you think.
I was gonna say, so you're asking me to time the market and tell you when
Oh
we're at
yeah,
the very
we're
bottom?
doing our predictions episode. Did you not hear what I was saying earlier? You might have heard December, but what I really meant was prediction episodes in May.
Right. I think it's a good time to buy. I think it's a good time to buy condos because even if you buy at, let's just say $200,000 today and you see another 10% reduction and it goes down to 180, but if you're going to hold that property for 10 years, at some point in the future, it's going to be back to 200, 220, 250. Do you really care if it goes down over the next year, as long as you have a tenant that is in there paying the mortgage or paying the rent that you use to then pay the mortgage? Do you care if the value goes down? And the answer to that is you probably do, but you actually shouldn't care. I just got my property assessments. I have 4 condos that are all in Denver proper. Each one of them lost between 5 and 7% on the assessed value over the last 24 months. Guess what that means for me? Lower property taxes. Do I care? No, because I'm not trying to liquidate them. I am happy that rents are still coming in. I'm going to have a little bit lower property taxes for the next 2 years. I understand that values go up and down. I think now is a great time to buy. Could you wait 3 more months and maybe get a better deal? Maybe, but who knows? Back to what we spoke about earlier, there's a lot of swings in rhetoric. Something might change tomorrow that prices skyrocket when interest rates go back to 5%, right? Do you want to wait for that and then you're trying to buy, or do you want to be ahead of everybody else that's sitting on the sidelines? I prefer to be ahead.
It seems like every time we do this Pulse podcast, we're all buy. It's like a great time, best time ever. Like, when is not a good time?
I can tell you, if you go back and you look over the last 40 years, there was precisely one time, and you're doing backwards analysis, right? There was precisely one time that if you would have bought a property and held it for less than 3 years, you should have waited. Do you know when that was?
Let me guess. The very end of 2007.
Fourth quarter 2007. If you were going to buy a property and hold it for less than 3 years, you should have waited in fourth quarter of 2007. Other than that, it is always a good time to buy. Waiting, again, historically, waiting to buy property is always a bad decision.
Just as a note, fourth quarter 2007 is when I bought my first fix and flip.
You should have been listening to me and Kevin on the podcast. We
Where
were
was
telling
the
you to buy.
podcast back then?
Who knows? We would have been like, buy.
Right. We probably would have been saying the same thing. And here's the thing, come back in a year from now, if you bought a property and it loses money, flame us on YouTube or Facebook. You know, you may lose money. You may buy a property and it may go down in value, but if you're going to hold it for 5 years or 10 years, it will make money. There's never been a time in the Denver market that if you bought a property and held it for 10 years, that it did not regain all of its value, including fourth quarter of 2007. So what I said there is, if you bought it and only held it for 3 years, you absolutely lost money. But if you held it for 10 years, from 2007 to 2017, you made money.
Yep. Okay. So time to buy now. We like condos. This is your strategy. Down 8% in Denver proper. There is opportunities out there. I hear the pain, guys. I'm hearing people talking about this that are flipping. We don't have a lot of flippers doing condos, but I have new developers that built condos. Mm-hmm. So I know that there's a challenge right now. So how do we do it if we can't finance it? I know we talked a little bit about DSCR in previous podcasts, but does that product work for your strategy that you're presenting here?
It does, with the exception of insurance. If the master insurance policy is greater than 5% deductible, I do not have a product for that. And I have spent countless hours of my life trying to figure out a solution. And there's exactly 2 that I know about. Number 1 is First Bank, that they will lend on a homeowners association that has greater than a 5% greater than 5% wind insurance deductible. And the other one, and I don't want to speak for you guys, I think Pine Financial will do it if you have a solid strategy to buy the property and resell it very rapidly. I don't think Pine Financial has any restrictions on that, although I may be speaking out of turn. Those are the only two solutions I know for somebody that's buying in a homeowners association that has really big insurance problems.
It sounds like, Joe, you just added something to review in our underwriting guidelines.
Yeah,
conversations.
exactly. We might have to edit that.
See you guys.
We might have to edit that out.
So to
there's
answer your question,
insurance
though,
for that, though. Isn't there insurance to cover any special assessments? So if there's a claim and the deductible's 8% and not 5%, and they can't cover the deductible, all they're going to do is go to the homeowners and say, pony up, here's your special assessment, everyone chip in. And I think there's policies out there that cover any assessments from the HOA. So can you get financing through maybe a different type of bank or a DSCR loan if you have insurance against the special assessment?
So the answer to that is two-pronged. Yes, there's absolutely special assessment insurance, and I absolutely think you should have it. I actually had a special assessment on one of my properties, filed the claim through my HO6 policy. They paid it in like a week. It was awesome. However, that does not solve the problem. Fannie Mae, Freddie Mac, FHA, VA, they are very open. Even with special assessment coverage, they do not accept condos that have greater than 5% wind and hail deductible.
What about your DSCR though? That's a portfolio
DSCR,
product.
That is a portfolio product. Also, no. And part of this stems back to, and this is not going to make 100% logical sense, but part of it stems back to that condo in Florida that fell down 5 years ago. And there was all sorts of insurance problems with it. And because of that, they just say, you know what, we're not going to take a logical approach on a case-by-case basis and say, oh, you've got 8% wind and hail deductible and this particular buyer has special assessment coverage. They've just said, nope, we want to make sure that everybody has enough insurance, because if you have that level of insurance, guess what the insurance company is probably doing? Inspecting the property to make sure that it's not going to fall down.
Yeah, that would be smart.
Yep. So outside of again, First Bank and potentially Pine Financial, I don't have a lot of solutions for if you find a project that has that high insurance deductible, but here's a strategy you could use. Pay cash, get on the HOA board, which is the easiest thing of all time. Nobody wants to be on an HOA board. If you go to the report or go to the meeting and say, I'd like to be on the board, they will like hand you the keys. They're like, here. And then all you got to do is say, great, I'm going to call the insurance company, change it back to 5% insurance deductible, raise everybody's HOA dues, fix up the reserves. Guess what? I now have a warrantable project that I can gain 10 to 20% in a very short period of time by moving that from a non-warrantable to a warrantable condo. But you do have to pay cash and you do have to put in some work to do it.
And then are you suggesting, just to make sure I hear this correctly, that you flip out of that after it's warrantable and then resign from the board?
That's exactly what I would do.
You crack me up. All right.
Hey man, you're asking for investment strategies. That's not
That is an
unethical.
interesting strategy. I mean, yeah, that's interesting. All right, guys, I think we're running short on time here. Is there anything else, Coop or Massey, that you'd like to add to our Denver listening base here? Guess that's
Mr.
a
Cooper?
no.
I mean, I think, along with these tariffs and the deportations, when you're coming up on fix and flips, when you're coming up on the BRRRR strategy for your rentals, we got to be planning on potentially longer holding times, right? I mean, we really need to be stress testing our deals. Material costs are going up. A lot of our labor force is being deported. So we're having labor shortages. And so plan on longer holding times, plan on higher material costs. And go buy those lower end condos because they're not going to take as much work.
That's exactly right. I think you're exactly right. For me, I don't have anything else to add. I mean, I think I really hit the nail on, hit my high points, I guess, I think it's a good time to buy. And I think there's opportunities in condos, and I think there's opportunities coming. The last shameless advertisement is I did write another book, The Mortgage Escape Plan. This is how you can eliminate your mortgage in 7 to 10 years without changing your lifestyle. So you can find this on Amazon as well. Mr. Justin Cooper was one of the contributors helping me write one of the chapters in this book. I would love it if you want to check out that book or our AI book for real estate agents. Please download a copy and leave me a 5-star review. And gents, thanks so much for having me. I always enjoy these conversations with you both.
Yeah, I really appreciate you both on the show today. And for the listener, Pine Financial, I think Coop did a great job saying what we do. We do raise private capital. We have a public fund. As Joe was saying, you see people divest from equities when there's uncertainty and into debt. So they go from stocks into bonds. Bonds are paying 4.5%, 5% maybe, depending on the bond. The safer stuff is paying 4.5%. We pay 8% and it's backed by real estate. So it could be a good option for you. If you want to check that out, you can get more information at pinefinancialgroup.com. Gentlemen, you have lots of things you could be doing and you chose to hang out with me for an hour. I know we always have a great time doing this. I had a blast. Especially with the jokes right before we hit record. You guys are hilarious. But I really do appreciate your time today. And for the listener, there's other podcasts you could choose from, and you chose to listen to the Real Estate Educators in our Market Pulse in Denver. Really, really appreciate that. If you got value, if you had some fun, please 5-star review, share it with a friend, and I hope you make this day a great one. Thanks, guys. Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.